Candle Range Theory Trader back with you with a very important video talking about how small ranges can equal big money in the Candle Range Theory. So let's not waste time and get right into it. So this concept comes from world-renowned trader, stock trader, and commodities, I believe, Larry Williams. And this is where this concept comes from. Larry Williams is quoted as saying that he or we look for markets that have been volatile in the past and are known for large daily ranges but have recently produced small daily ranges. Okay, that's what we're focusing on. This is based on the daily chart. Because we know a small range day is out there not too far away, you can eliminate the madness in the charts by laying low on the sidelines, carefully waiting until ranges have dwindled and dried up. After that part's over of the natural cycle, it is time for short-term fireworks. So there's two ways to trade small candle bodies. Okay, we're talking about on the daily chart. We're only talking about not the wicks, but just the open and close of the daily candle. You can look for a sweep or a breakout. Okay, here is that represented visually as far as the candle range theory goes. The sweep is this. This is a short example. After you identify a small candle range on the daily chart, okay, you look for price to sweep the prior day high and then just reverse downward and ideally take out the opposite end of the range or the prior day low. Okay, so let's say if this is Monday, this is Monday's high, this is Monday's low, but it produces a small body. The next day, for this bearish example, price opens here, it shoots up here. You wait for the money candle on the 5-minute chart, and I'll go over this, to be produced. You take a short either up here or down here near the prior day high in hopes that price will just continue down for the rest of the day. That's it. Okay, but the smaller the body of the candle, the better. All right, that's how that goes. 50 pips is like the max, but if you see like a 20 pip, a 10 pip, or a 1 pip, that's ideal. Now, next up in terms of the breakout, what we're looking at is a breakout of price either below the prior day low or above the prior day high. This is a bearish example where price broke out of the low. So once again, you look for a small daily range that's 50 pips or less, and then you wait for price to break out of the low, and you just want to get in either somewhere around this range low, or you may see a swing high or a fair value gap. I'll get into that in terms of where the entries could be for a breakout of the range. That could be to the upside or to the downside. The key for breakouts, though, is this: the prior day high in this case won't even be a factor. You should not see price going all the way up to the high and then coming back. No, it should be like an open price. It may retrace a little bit, but then just eventually break out. The prior day high in this case won't even be threatened. Okay, that's the main way you know that price is just going to continue. All right, so that's that. Now, the indicators that you're going to need: the non-negotiables are mark levels for the highlighting the prior day high, prior day low, and also the daily open if you want to throw that in there. And an indicator called height of candle body. It's by Push Patil 1997, and I'll show you that. Okay, that gives the height of the candle, so you don't have to measure each candle. All right. And then if you want to trade breakouts, two helpful indicators will be fair value gaps. There's multiple ones. I use the one by Nephew Sam, or any indicator that's going to show you a swing high or swing low. So there's tons of those as well. Pick the one you like the best. So here's the decision flow if you want to trade sweeps. And again, what are sweeps? Sweep is this pattern right here, the two candle pattern. All right. First off, on the daily chart, is the candle body less than 50 pips? 50 pips or less. The smaller the better. Yes, okay. Is price at or near the prior low or prior high of the day? If so, yes, you want to see a false breakout of that. And then you want to wait on the money candle. The money candle being on the 5-minute chart that creates the high or low of the day. Once that candle gets closed below, then you enter the trade, set your stop loss above the high or low, and you take profit on the opposite side of the range. Okay. For the breakout, you're going to be on the daily chart. Is the candle chart, is the candle body less than 50 pips, 50 or less? Okay, has price broken out of the higher low? And then you want to enter the trade either near the higher low or on a fair value gap or on a swing higher low. Again, I'll show you this. All of this is on the 5-minute chart. Now, stop losses and take profit. Stop loss is easy enough where you want to set it below a fair value gap or below a swing point. Your take profit, I would recommend anywhere from 1 to 3 to 1 to 5. It is a breakout, and some breakouts can go really far. It just depends, because remember, we're counting on the small candle to lead to a big candle. But let's take a look. So these are some sweeps. These are some examples. This will be the only example I'll show you of an entry, and then I'll show you the rest on a live chart. But this is the daily chart right here, what my mouse is. These two large candles. So the candle range day is 22 pips. So the body of this candle right here is only 22 pips. Perfect. All right. Now, the trading day is Friday, where we look for price to open, go down and sweep the low, and then come back. And that's what it does right here. Price opens, goes down and sweeps the low, and then comes back. So the best entry here, I try to trade London no later than 1 a.m. though. Consolidation around the range low, which is right here on this daily chart, is fine to look for a continuation to the upside. This trade went for 100 pips, okay, to the upside. But it was all started on identifying a small range, okay? Here's another example where you have this red candle here was a 19 pip body. This is a standard three candle range theory pattern here. But at the same time, the rules are still the same. You enter somewhere off this low here, and then the expansion move, though, didn't come until the next day. So this is 3 days, 2-day play out total. So your trading day was right here, and then your payday was right here. See how far price broke out of the range, and it went for 100 pips, okay? So sometimes you'll see that as well. It'll either be like this, okay, right there. But sometimes you will run into this. Sometimes you will run into this as well, where the expansion comes a little later. All right, so this is another one on Aussie dollar. This is a 9 pip body. Remember I told you the smaller the range of the daily candle, the better. Price opens, it goes down, sweeps the prior day low, and then goes up. This was good for 60 pips. Okay, to the upside, your take profit is the opposite side of the range. Okay, and here's another one for EuroCAD. This is a short example. So this was a 46 pip candle body. It's still under 50, so that's fine. Price opens, it sweeps the high. High of day is created and then reverses the rest of the day. That's all you're looking for. 114 pips down to the downside. That doesn't mean you're trying to catch all 114 pips. You could have got, 50, 60, 70, whatever you can get. Okay, but this is best case scenario where you like to see it in 1 day or sometimes 2 days like this here. All right, either one of those is fine. Now for breakouts, here we go. This is the daily chart right here. Okay, this is the range day. This was a 19 pip range from top to bottom. Okay, notice how price did not come back to the prior day high. It did retrace some, but then it's ultimately tanked. So this right here, this is the daily open. This price action right here is this red candle right here, not this one. This one is just, I included it by accident. But this day is the breakout. All of this trading though actually takes place outside of the range. So your ideal trading time would have been from 3:15 to about 4:25. And we talked about the swing highs. So this is a swing high. The indicator said, hey, this is a zone here. So what I like to do is just draw a box around the 3 candles that create the swing high. And when price retraces back into it, I look to enter. And as long as the high of this candle holds, then the trade is valid. And obviously you get that. You did get a sharp retrace, but then price came right back down. So you don't let this types of price action scare you out of it. Scare you out of a good trade. Okay, because you're trusting in the momentum of the trade at that point. So there you go. Let's see. Here's another one. This right here. This is tiny. Look at this. This is a 0.04 pip range. This little line right here was a whole day. And then price broke out to the downside. Any entry around the range would have been fine. You just catch the straight drop. 150 pips. That doesn't mean you get all 150. Maybe you could have got 50. Maybe you could have got 100. Either way, all of this was for you based on the breakout of the range. And again, the prior day high wasn't even a factor. All right. But again, it's based off the tight daily range. And then here's another 12 pip daily range. So packed in nice and tight. Price open, went down, broke out of the range, went up for 150 pips. Any part of that, you just go ahead and grab. All right. So let's do a live example now. So now I'll go to the chart. Let me get a quick sip of water. And let's show you how the indicator looks. So we're on TradingView now. Let's see here. What do we got? Okay, so again, to find the indicator, I don't know if I put it on my favorites or not, but candle height. Yeah, right here, height of candle body. That's the indicator you're looking for. Okay, let me put that on my favorites. Okay, but you're looking for that one. When you pop it on the chart, the numbers will pop up on the bottom left-hand side of the screen. Let me make this a little bigger so you can hopefully see. These numbers right here will reflect the body. Okay, so this right here is a 55 pip range, so we don't look at that. 11 pip range, that's good. 20 pip range. Okay, you see the numbers changing. That's the candle body height. Okay, 100, obviously we're not trading that. We'll look for those at 50 and below. Smaller the better, all right? And then our mark levels indicator, I've talked about that at length. So you just go to the settings and adjust. Be sure you have the prior day high and low checked, and the current high and low checked as well. That's all you need for that. I'm not going to spend too much time on that. So let's pick a pair at random, and then I'll show you. We'll do one example of a. Let's do one example of. I'll just do whatever pops up first. So let's go to. Let's try Aussie dollar. All right, and I'm just going to pick a random day. Let's go over here. All right, so here we go. So the first thing I'm doing is I'm scanning. I like to just use the bottom of the chart to see the numbers. And typically I like these bars to just be real low. So you got 16, that qualifies. But just because you see a low range doesn't mean that there will be a trade that day. That you just add that to your list. So let's see. Okay, so this one right here works. This is a 7 pip range. So let me do the replay. And right there. All right, I think I got the right one. Yeah, 7 pip range. I think this was a breakout, but I'm not sure. But what I do is I mark the high and low. This was on April 25th. Candle range high. Candle range low. Okay, so that's that. Now I'm going to go ahead and go to the next day, and then we see where our trade would have been. I think this was a long. It broke out of the range. No, it's a sweep. Okay, a sweep. All right. So remember, when we have a breakout, price shouldn't touch the prior day low. If it's touching the prior day low on a tight range, you're going to want to treat that as a sweep. Okay, and you'll know that because whatever price typically does first. So because it opened and went down, we're looking for a sweep there because we're expecting it to reverse because it shouldn't be approaching the prior day low if it's going to break out. Ideally, okay, it's not 100%, but ideally. So that's how we understand price action if we're trading this. So let's see. If we go down to the lower time frame here, this is the 5-minute. Our best entry would have been between about 4:10 and about between 4:10 and 5 o'clock. Perfect. You could have got in right there. Obviously, you want a pyramid. I still teach pyramiding. Okay, with another couple entries either right here on these green closes here and here, close to the range bottom. Okay, that's just what I do. And then if we go to our forecast, based on our base position, this was good for more than 50 pips. So this was good for 1 to 5. Okay. So what the price does on the open is very important. But you see here, price went down and then swept again. It's just a multi-session W, however you want to look at it. Okay, and then went up to the upside. All right, but that was a sweep example. All right, so tight range. I'm sure, but anybody who went short here got killed. Why? Because price opened and then swept the prior day low. So I promise people were looking for a breakout of this low, but it didn't happen. Look what happened when the candle closed. When you trade this model here on the tight ranges, you can feel confident in holding until the day ends. Hold until the day ends, or at least until your TP is hit. Okay, so don't exit too early. Have confidence in your trade that price is going to hit the other side of the range. Okay, so that's that. Okay, so that's one. Let me go to another pair. So what was that? That was a sweep. So let's try to find a breakout. Get rid of that. Okay, so we're back on the daily chart. I'm going to go to just do dollar Swiss. Find a small range. Not quite. Not quite. Not quite. Okay, this one will work. Okay, so this candle right here, let me go to the daily or to this example here. All right, so first things first, and it's already set up, so we'll just go to the entry after we mark the candle range high and low. So we mark the high, we mark the low. Why? Because this candle range, the body of this candle is 22 pips. That's under 50, so that fits our purview. Okay, so right there. Notice as well, best case scenario, we like for this prior day low to not even get hit. It's not even a factor. Price isn't even interested in going down there. We want to see just a straight breakout. So if we go down to the 5 minute now, let's see what our best entry would have been. Now we'd like to enter somewhere around the range high. Okay, because the open price is all the way back here. This was at 5 p.m. Eastern Standard Time. Price did break out of the range a little bit, but anybody who went long up here got toasted. You want to try to be in around the range high here. If you can get in below the daily open, even better. But ideally, just somewhere in here would have been the best trade. That is between 350, really all the way till about 830. All of that, either one of these entries could have been fine. But remember, we also have fair value gaps as an option or swing highs and lows. So I'm going to take a look at some. I like swing highs and lows more than fair value gaps. So that's what I'm going to do. In this case, fair value gaps may have been a better option, but here is the swing low off of the low of the day. And what I like to do, like I said, is I draw a box around the 3 candles that make it. Just like that. Bang. So now that I got a swing low off the low of the day, and I'm expecting price to break out of the range, okay, based on, it already broke out once, so it just retraced, and then I'm expecting it to come back again. Best entry was anywhere from 6:20 a.m. until about, I'll give you all the way until about 8:25, anywhere in there. And like I said, you still pyramid on in. You can take an entry here, another one here. I'm only buying strength. I don't buy on the reds. Another one there, another one there. Okay, like that. Obviously, I'm not trying to really add up here. I want to be in though around the low. And we'll just say another one right there. Either way. All right, so about like that. Okay, so there you go. There's that. From the base position, you could have got away with a 10 pip stop loss. And that was good for 1 to 5 on the base position. So that worked out really well. It did go even further. But let me go back to the daily. Make this a little bigger. Okay, but obviously these are other entries right here on the daily chart. Okay, like that. Expecting the breakout because of this tight candle range right here. Okay, 22 pips. All right, price came nowhere near. It broke out, came back in, and then broke back out. Some people they call this, I've also heard this called a break and retest. Same deal. Okay, same deal. All right. But the only difference is, like I said, the range is our trigger to look for it. All right, so that's that. So that's how you can backtest this on your own once you get all the indicators on your chart. Let's go ahead and wrap this video up. So in conclusion, small candles can equal big moves. If you want to do ranges less than 50, that's fine. So let's say you only want to focus on candle ranges that are less than 40 pips or less than 30 pips. That's fine too. You can do that. That's fine. Smaller the better. Manage risk. You'll be fine. Don't worry about any of the losers. Sometimes the small candle body will be the second candle in the candle range theory pattern, meaning this right here. This also qualifies as a range, but this would be a breakout. Hope that makes sense. So just cut this red candle off. This is candle range high, candle range low, and then this is a breakout. So just a little different, but you'll learn that with chart time and experience. Okay. So, but because you treated this as the range, this was a sweep. So a sweep and then a breakout. Either way though, either one of those would have been fine because there's still 2 tight ranges. I hope that makes sense. So you can see both. Let's see here. Sometimes, you already read that. So no need to worry about daily bias. Just make a habit of reacting. How do you react? If price sweeps the high or low of the prior day, look for the reversal. You look for this. Okay, that's the reversal. Okay, that is not a breakout. Anybody who bought the breakout up here got killed. All the longs up here got killed because price opened, fooled everybody into thinking we're going long, and then killed every single one of them. Okay, that's not how we do things. So you want to do the opposite. If price breaks out of the higher low of the prior day, then you look for the continuation. But remember, for breakouts, typically you won't even see price touch the prior day low or prior day high because the momentum's already present. That's the main clue, like this right here. This prior day low isn't even a factor. You'll see like just like a shallow retrace, and then price just pops out. Okay, and ideally as well, if price closes near the high as well, that could be another good signal that it could just continue on up. Okay, so that's another thing too. I prefer sweeps, not necessarily breakouts, but either one is fine. Whatever makes money is fine with me. Okay, so refer to the video how to read intraday price action for other entry possibilities if you missed the best entry. Now here's one more bonus based on the Larry Williams quote. He did say that they look for ranges that are known for a high volatility. So these are, as of current, as of making this video, these are the currency pairs, the top 5 that are known for having very volatile daily ranges or high daily ranges. In other words, because they move on average of anywhere from 200 to 130 pips per day across all of them, anytime you see a range that has like 30 pips or 20 pips, that's an anomaly because it's on average, it's moving higher. So you're looking for that consolidation to lead to an expansion. So here's an example of that. This is a pound yen. So see here, you have a 21 pip body. That's way below average. So you have a sweep the very next day. Here's a 37 pip body, okay, below 50. And then the next day it sweeps below it. Our entry would have been down here somewhere. There's the expansion candle right there, okay. Here's another one here with a 22 pip range. And this could have been a breakout. So you could have taken the trade above the high there. And obviously you got 2 more days of rise after the breakout occurred. 1, 2 right there. Okay. So these are the anomaly daily candle ranges on a pair that otherwise have big fat ranges. So that's the benefit of knowing when a pair is below average and this tight range led to this big fat candle. Okay. So you want to see big fat moves. By the time this happens, price, the big move's already done. Okay. So that's that. All right. Did I do one more? No, that was the last one. Okay. So, but these I'll go back. So if you want to pause this, take a screenshot, do whatever. As of the making of this video, if you want to look for just these pairs or high ADR pairs and look for the tight candles on that one, that's fine because, it's just a matter of time before a small candle leads to possibly a 200 pip move in a day. You get one of those a week. If you can get 200 pips a week just doing this, 5 positions on, we'll say 150. If you get 5 positions on 150 pips, I mean, come on, you're writing your own paycheck, right? But you got to start somewhere, and the place you can start is small daily ranges. So I appreciate your time and attention. Hope you got something out of this video. Definitely check the links in the description, and have a great rest of your day. Take care.